Ladies and gentlemen, welcome to our latest podcast. Now, I have the absolute pleasure of introducing what I feel is probably the most underrated research guy in the industry. I'm here to pump his tires because he deserves it, and I'll explain why in a moment. He picked the stock of the year for 2024, so we'll sneak a little question on what his stock pick for 2025 is. But first, Zach, how are you?
Thanks, John. Thanks for the kind welcome. As always, I'm well, thank you.
So, just a bit of background. Zach's from Banyan Tree Investments, great research house. Red Leaf actually uses Banyan Tree for research purposes, and we have a white labeling agreement on particular stocks. We'll get into that later. But first, let's have a recap of the year, Zach. How did you see markets in 2024?
Yeah, look, obviously, if you read the newspapers, John, you'd think we're down 20% because of all the negativity. But if you look at your portfolios, whether it's multi-asset, Australian equities as well, and global equities especially, it's been a great year. And I think, and I've been traveling around talking to clients, and I think one of the things that we got wrong, or the markets got wrong, we got very comfortable with the rally and where it was going to go by the mid part of this year. Was there was enough liquidity around? The Fed was going to start cutting rates, whether that and that was going to have a positive impact on obviously sentiment at the very least. Bond yields actually rose despite the Fed cutting. We can touch on that why. But the other part was earnings were holding up. And a key part that I think a lot of equity investors, John, got wrong a bit was that the expectation at the start of this year was because of the massive rises in interest rates that and the subsequent rises in inflation and the rise in inflation, the rise in interest rates, and the rises in wages was going to impact margins. But the numbers as they played out was because there's enough inflation around, and people tend to forget this, good, healthy level of inflation is good for equities because you can pass through price increases. In fact, you can raise price increases. And long story short, what you found is, and I can show a chart if you want me to, margins held up because whilst wages pressures were coming through, cost pressures were coming through, companies generally were able to pass through price increases, and that ended up being good for earnings. And final point, if you look at third quarter earnings in the US, expectation, John, heading into the earnings season was for 4.5% or 4.3%. As of 90% of the market capitalization completed their earnings reports, the EPS growth for third quarter was 8.3% or thereabouts, so double of what you expected. But the key learning for us was that there was enough liquidity around, earnings were holding up because margins were holding up, and obviously we're going to have a good finish to the year.
So, in terms of looking ahead in 2025 from a macro perspective, do you see the same elements in play? Will they be able to maintain margins? Which sectors should investors look at, particularly given with newly President-elect Trump? What should investors look out for in 2025?
Yeah, look, there's going to be a degree of uncertainty. Look, obviously, given the rally that we've had this year, given the returns we've had this year, there's going to be an element of market fatigue. I think that early next year, there will be opportunities. Market and investors in general look for opportunities to take some profits. So I don't expect a smooth sailing. But firstly, before I touch on the fundamental, let me take you just a quick view on the technical. Purely on numbers, if you look at the last 20 years of US election cycle, whatever the trend was heading into the election, it tends to be followed post the election. So if the returns were positive, you tend to get a positive outcome, regardless of who won, regardless of what factors were driving. So this is purely data. We like to look at purely data. I mean, we're fundamental bottom-up, top-down guys, but sometimes you want to take the human bias out. So let me give your viewers that piece of information. It was done by a US investment bank. Simply, if you look at the data, the trend that was following pre-election tends to follow. It tends to follow afterwards. Now, one of the best performing factors heading into the election and since the election has been momentum. momentum, stocks that are doing well, whether their earnings upgrade, et cetera, or got momentum behind their share prices. Whenever a factor has outperformed by 15% or more heading into the election, post-election, that trend tends to continue and you get an average return of 9% or thereabouts, and it's accurate 88% of the time. So the point is, purely focus on the data, there's a good chance that this rally continues. Now, let's talk about the fundamental reasons, right? We know Trump is pro-growth. We know Trump is going to introduce tax cuts, but there are hypocritical issues with some of the Trump fiscal policies as well. We know he wants to bring in big tariffs. Now, that could be inflationary. That could mean you may see yields higher, which will have a tax on the economy because cost of capital goes up. And then obviously, adding tariffs could also suppress demand, which has a negative feedback loop, obviously, for the economic growth. So there's a bunch of permutations and combinations that are going to happen next year. In terms of where we would focus, honestly, John, it will come down to individual stock picks. It will come down to sectors which are growing. Come down to stocks which are growing, picking up market share, have really good solid margin outcomes, regardless of the macro, have good management teams, and have good balance sheets. If you're going to play the cyclical sectors, be very careful. That would be my point. We run very balanced portfolios in terms of all diversified portfolios, both for our global equity strategies and Australian equity strategies. So we've got let's talk about one particular sector that Trump is going to have a material impact on, and that's oil and gas markets. If you look at his U.S. Treasury Secretary pick, Scott Bassett, he's come out and said, he wants 3 million additional barrels of oil every day. Now, that will have a negative impact on oil and gas stocks. Obviously, you've seen the Santos, the Woodside's lag. There's a bit of negative sentiment in there because if you're going to pump out more oil, that's going to have an impact on oil prices. But it could be really positive for oil services companies. So Worley Parsons is one that we like. And globally, Halliburton, Baker Hughes, they've already started to move. So all I'm suggesting is that given the permutations and combinations, don't expect the same level of return next year. We still think as long as earnings are holding up, jobs market is still holding up, you're still likely to get that 8 to 12% growth, earnings and dividend yield next year, but it won't be a smooth trajectory. And at the end of the day, I'd be careful of cyclicals, and I'd be more focused on stocks which are just growing because either they're picking up market share and their margins are growing.
Do you feel there's a good opportunity for micro and small cap stocks, given that they've underperformed to their large cap peers going into 2025?
Look, from a valuation perspective, absolutely. Opportunities perspective, absolutely. Because these are the next big ASX 300 or this S&P 500 stock if their trajectory continues. I think the biggest issue just around, it's not the valuation. It's not that some of these companies are very high quality. I think the issue just is that the market sentiment is so kind of underwhelming right now, given the rally we've had. That they are just a bit cautious on spending, or taking risk, unnecessary risk in their perceived eye. Because as you know, John, there are some really good high quality companies which are not speculative. They're earning money, they've got margin growth, and they've got plenty of growth runway ahead of them. But the issue really is companies, market tends to be a little bit cautious when there's kind of uncertainty around the macro. But like I said to you off air before, we have for the first time in our multi-asset strategy actually introduced a microcap strategy to our mandates, and that again just shows you that look, we don't know when the turn will come. Can we find good quality companies, or can we find someone who can find good quality companies within a well-defined risk management framework? And then, whenever the turn comes, the turn will come, but we want to be there. So that's pretty much how we're looking at the microcap sector right now.
Now, talking about stock selection and an amazing stock selection, you can see it here, a Red Leaf support, research report. You casually picked Findi Ltd. All right, we might have gave you the idea, but you were the brains behind it. It's up 900 odd percent for the year. Tell me, what are the learnings and how'd you go about this research report?
Yeah, look, it's always nice when someone, and we're so fortunate that we work with so many groups like yourself, both advisors, high net worth, and brokers, and we get ideas all the time, not just through our watch lists and screens that we run, but also guys like such as yourself. But look, the 800%, 900% return is great. There's a bit of luck involved, and you need a bit of luck in this. But I'll focus on the research side, which is obviously where you do need a bit of skill and an element of good skills. So look, Findi obviously came to us. I think there's a couple of great learnings about Findi that I'd probably share. First and foremost, the macro, as we saw it, was very positive. In terms of the region that they were focused in is India, and the sector they were focused in, which is cash economy and ATMs. I think this is where one thing we got the core right, where most investors sitting in their ivory towers in Australia, John, would have said, ATMs, mate, this is not 1990s. What's wrong with you? But you didn't understand the nuances of how people in India were still dealing with cash. And just to give you a really good example, right? Even if I get paid there are some, not saying all, even in the more rural and semi-rural areas, even if you got paid digitally, which is obviously the Indian government is all trying to get a push towards, because they want to bring the black economy to the real economy, they would still withdraw the money and still use the cash basis economy to do their transaction. Here's another interesting thing, right? And which I think we touched off in the report as well. Even online deliveries. So they wouldn't use credit cards to pay for online stuff because they don't trust it, right? It's still a very skeptical society because there's a lot of frauds. So even Amazon or any online delivery, they'll come to the front door and they'll pay in cash there. So understanding that nuance, that cultural nuance was very important. So India as a growth story was important, and understanding the purpose and still the relevance of ATMs was very important, and we got that right. And then beyond that, obviously, just this was not a speculative company. It was earning money. It had the management team had given guidance around that. So there was top line growth, there was margin expansion, and there was bottom line growth, combined with a pretty good balance sheet that was enough to fund their growth. So when we actually did the numbers, in fact, I think we may have even raised it with you and the management team and said, this valuation doesn't make sense. And if you look at the report, the stock was 44 cents. The valuation that we put was $3.40. And to most people, and again, as you know, John, when we work together, we are genuinely trying to advise clients what we genuinely believe this company is worth. And at the time, it may have looked stupid that how do you get a valuation? But that was what it was. It was trading on 3 times. So I think understanding how the free cash flow profile is going to work, understanding that the growth, the top line growth, how that was going to permeate given the macro and micro nuances of the market was operating. And then the valuation was just silly. So the company had provided the guidance. And so, when you put all that together, we came out with a stock that just looked stupidly cheap for what it was offering. And, I will say that we did absolutely thump the table on Findi, and I'm glad, the returns that what they are. But it was a great learning experience. Again, a reminder for us.
And Zach, we thank you. Like, we got a lot of happier clients off the back of that. Now, 24's in the past. I'm going to put you on the spot. You know what I'm going to ask? What's your pick for 2025?
You know what's the great thing about being an investment manager, unless you're only as good as your last call, right? So because people move on and yeah. So look, I don't think we'll repeat something like Fendi again. But again, I have a name for you. We still haven't got kind of a key pick, but this is a stock, again, I really like from a multi-year perspective. It's a stock that's not, that's struggling or people don't know about it. It's actually Life 360, and it's a growth stock. It's something that's picking up market share, and it's got a very healthy top line growth and bottom line growth. It's got margin expansion story. So what does Life 360 do? And I think let me just tie that up with the macro. If we're heading into a period, John, next year where there will be uncertainty, we don't know which way the fiscal and macro monetary policies will go because Trump doesn't know what he's going to do himself. Bring it back to basics. And I said this at the top of the conversation. We need to pick stocks that are either growing on their own accord because they're offering something value. Now, if you look at Life 360, what does Life 360 do? Provide security, allows you to monitor family members, whether it's elderly, your children. If you're driving somewhere, there's a car crash, it automatically notifies your family members. Calls the ambulance. This is something that's got monthly active users of about 70 odd million people. Now, that's a very good base to start off with. So it's got a very active and a healthy base to work off. It's growing globally. Right now, 80-90% of its market is still US. It's growing globally. It's growing in Australia as well. There's a very healthy element of new subscriber growth outside of the US. But one of the kicker that Life 360 has, and I think next year could be a catalyst. That's another thing I would say about Findi. There was catalyst-rich elements about Findi in 2024, which, to credit to the company, they delivered. Same with 360. I think one of the catalysts that will be critical for 360, Life 360, will be the advertising. They're trying to introduce advertising into their platform, which is pretty much next to none right now. And let me just give you an example, and this is off the back of what company provided. When Uber started introducing advertising, their revenue went from $11 million in first year to $900 million by year 4. So if you've got a captured market, you've got an active market, subscriber base, and you're growing, you've got the opportunity to use that to go into new markets, new segments. So they're looking to move into family financial services, auto insurance, elderly monitoring is another thing Life 360 is looking to move into. I've had some experience with that right now. I think some of the elderly monitoring services are not that good, and so again, there are segments that can move into. That advertising market could be a key catalyst. And I think this is a stock that could continue to grow regardless of the broader macro. And then just for your clients, look, another couple of names from a cyclical perspective. If you're looking in materials, Champion Iron, that mid-tier, Champion Iron mid-tier. Again, why do we like it? Long-term growth. It actually high-quality iron ore reduces the carbon emissions. It's getting more and more interest from global buyers because they understand their responsibility around contribution to the environment, and because of a high quality iron ore, it gets a premium on its on the base iron ore price, and so we think there's a really good opportunity for Champion Iron Ore for multi-year growth, plus increasing shareholder returns. And so in the cyclical sector, Champion Iron Ore is looking really nice from our perspective. So there's a couple of names for your clients to consider.
Ladies and gentlemen, you heard it from what I consider the best analyst research guy in the country. It's Life 360 and Champion Iron for 2025. Zach, Merry Christmas, Happy New Year. We appreciate all your support and we'll love to see your next research out on those companies.
Lovely. Thank you, John. Thank you, everybody.